Howdy, everybody. Welcome to Liberty Call for Monday, April 14th, 2025. Hope you're having a fantastical day out there. It's a pretty nice day here in Colorado. It's a little chillier than I would like, but, it is still, springtime, so we get a little cold weather occasionally. So, anyways, all right. Well, markets are catching a breather as the White House blinks, granting temporary tariff exemptions on tech gear like smartphones and laptops. The Nasdaq's leading the way higher, but recession fears aren't going anywhere. Inflation expectations are creeping up, and Wall Street's bracing for more policy whiplash. So before we break all the news down, I need some help from you. If you could give me some thumbs up, a like, share, subscribe, and follow, and press that darn notification bell. All right, let's get into the markets. Dow Jones up 0.78%, 312 points, closed at 4524. S&P 500 up 0.84%, 44 points, closed at 5408. NASDAQ up 0.64%, 107 points, closed at 16,831. VIX down 17.57% today. It's at 3096. Canada up 1.18%, Brazil up 1.52%, and Mexico up 1.56%. In Europe, Germany was up 2.61, the UK up 2.14, France up 2.37, Netherlands up 2.41, Spain up 2.64, Italy up 2.88, Switzerland up 2.51, and Portugal up 0.95, kind of the laggard there across Western Europe. Russian exchange is mixed today. The MOEX down 0.34, RTSI up 1.15. And the overnight markets, the Nikkei in Japan was up 1.18%, Australia up 1.34%, and New Zealand up 1.35%. In China, the Shanghai up 0.76%, Shenzhen Component up 0.51%, China A50 up 0.34%, DJ Shanghai up 0.63%, Hang Seng up 2.4%, and the Taiwan weighted when it closed on the 11th was up 2.78%. Good stuff. I know. Exciting. Well, let's jump over to our weekly economic update. Stocks ended the week with a strong gain as traders continued to focus on tariff talks while appearing to overlook upbeat news on inflation. The S&P 500 rose 5.7%, while the NASDAQ gained 7.29%. The Dow was up 4.95%, and overseas markets increased by 0.72%. Stocks rebound. Stocks rallied on Monday after a report surfaced that the administration was considering a 90-day pause on tariffs. But when the White House clarified its position, sellers stepped in. On Tuesday, prices jumped at the next opening bell after the Treasury Secretary said the U.S. was open to tariff negotiations with trading partners. The rally stalled and reversed on news the administration was adjusting tariffs on Chinese imports. After the White House announced a 90-day pause on specific tariffs on Wednesday, markets pushed higher. The S&P 500 gained 9.5%, its largest one-day increase in 17 years. Stocks fell again Thursday morning, appearing to overlook an upbeat consumer price index report showing that core inflation, excluding food and energy, rose at a 2.8% annual rate, the best number in more than 4 years. Stocks finished the week with a powerful rally, capping a volatile trading week. All right. Watching the bond market, the yield on the 10-year Treasury note rose more than 50 basis points for the week, marking one of the most significant moves on record. When bond yields increase, bond prices tend to move lower. It's an inverse relationship. As people are buying up bonds, price goes up. As the price goes up with the bond, the yield goes down because you're paying more for the bond, so the coupon has less of a percentage yield. So, just math, folks. This week's action was unexpected. In the past, investors have turned to U.S. bonds during market turbulence. However, the ongoing tariff talks have at least temporarily influenced how some overseas investors view U.S. bonds. The bond market activity influenced the mortgage market, where the average rate on the popular 30-year fixed mortgage closed Friday at 7.1%, its highest level in 2 months. Key economic data coming out this week. Monday, Philadelphia Fed President Patrick Harker and Atlanta Fed President Bostic are speaking. Tuesday is the import price index. Wednesday is retail sales, industrial production, business inventories, home builder confidence index, and Cleveland Fed President Hammack speaks. Thursday, housing starts and building permits. Friday is the San Francisco Fed President Mary Daly is speaking. Companies reporting earnings this week. Monday, Goldman Sachs. Tuesday, Johnson & Johnson, Bank of America, and Citigroup. Wednesday, Abbott Labs and Prologis. Thursday is United Health Group, Netflix, American Express, Marsh & McLennan, Blackstone Group, and Infosys. All right, so that is the weekly update. Everyone feel smarter out there? Shake our heads up and down. Okay. All right, let's jump to the market recap. SP 500 jumps on signs of further tariff reprieves ahead. We shall see. The S&P 500 climbed on Monday as investors reacted positively to signs of potential further tariff reprieves and solid bank earnings to kick off the latest earnings season. President Donald Trump announced that tariffs on imported pharmaceuticals are still coming, but he hinted at a temporary exemption for automakers from the 25% tariffs imposed last month. This sent shares of General Motors, Ford, and Stellantis sharply higher. The White House also confirmed that smartphones, computers, and other electronics would be temporarily excluded from Trump's aggressive 145% tariffs on Chinese imports, granting some relief to tech giants like Apple and Dell, both of which saw gains on the day. However, Trump warned that tariffs on imported semiconductors could still be coming within the next week. The temporary exclusion was aimed at giving companies time to shift production to the U.S. Elsewhere, yeah, because you're going to shift, making semiconductors in a week. I mean, seriously. Elsewhere in the tech space, Intel rose more than 2% after agreeing to sell its majority stake in Altera to private equity firm Silver Lake. On the earnings front, Goldman Sachs reported a 15% jump in first quarter profit, driven by strong trading revenue and market volatility. Amid market volatility. The stock rose 2%, joining peers JP Morgan Chase and Morgan Stanley in reporting upbeat results. While bank earnings have been strong, investors remain cautious about the broader economic outlook as tariffs threaten to fuel inflation and potentially trigger a recession. Oh, no. Goldman Sachs CEO David Solomon acknowledged the uncertain market environment, but expressed confidence in the bank's ability to navigate the shifting landscape. Well, let's hope. Looking ahead, earnings reports from Johnson & Johnson, Bank of America, Citigroup, and United Airlines are due Tuesday, which will provide further insight into corporate America's outlook amid growing tariff tensions and market volatility. Yep. Good stuff, I know. All right, last up is the Monday Morning Outlook from Mr. Brian Westbury at First Trust. This week's article, Time to Cut Rates. So let's see what he means by that. Is it just really cutting rates, or is it time to do something different? During COVID, the Federal Reserve's quantitative easing (QE) policies differed significantly from the 2008 financial crisis. Unlike in 2008, COVID-era QE led to a massive surge in M2 money supply, fueling inflation, something few foresaw at the time. Wait a minute. I foresaw that in the summer of 2020. I bet we go back and find a video of me ranting and raving about how this is going to create a crap ton of inflation in the future. Yeah, it'll probably solve all of our, make you think you've solved all of your problems right now. But, in 2, 3, 5 years down the road, when everything is massively more expensive, is it the deal you thought it was? Probably not. I mean, those stimmy checks that you got direct deposited, or those prepaid credit cards or whatever they sent out, I'd rather deal with the downturn. Those who track M2, like authors of this report, were among the first to predict inflation would rise sharply due to those policies. And this guy right here. Now, with inflation moderating, there's a growing case for the Fed to begin loosening monetary policy. March saw a 0.1% decline in consumer prices, the biggest drop since early COVID lockdowns, and year-over-year inflation stands at 2.4%. The Fed's preferred PCE inflation metric is around 2.2, nearing the 2% target. The concern now is that the Fed waits too long to ease policy. Inflation could fall below the target and increase risk of recession. M2 is only growing at a 3.9% annually, well below the pre-COVID trend of 6%, which had corresponded with subdued 1.5% PCE inflation. In this context, a slightly looser monetary policy might or may be warranted. Maybe not. Despite widespread concerns, the report argues that tariffs won't lead to runaway inflation. Sure. Tariffs can raise prices on specific goods, but they reduce consumers' ability to spend elsewhere, often keeping overall inflation steady. However, tariffs may weigh on short-term economic growth if businesses delay relocating production in hopes that levies are temporary. The Fed, they argue, should consider a modest rate cut at its May or June meeting, while inflation is likely to average 2.5% or higher over the next decade. Near-term risks point lower. Gradual easing, along with relaxed bank regulations, could support the bond market and stabilize the economy without triggering excessive inflation or undermining the dollar. In short, inflation risks are down, growth risks are up, and cautious easing could be appropriate. Could. Me personally, I'm more of a slash and burn kind of guy. I would have been jacking those rates up to like 7 or 8 and just let the chips fall where they may and just deal with it. So, but that's just how I'm kind of a pull the Band-Aid off. just deal with the problem immediately, as opposed to, the way our government does things, they just postpone it into the future. All right. Well, that's everything that I had to cover for today. If anyone needs anything from me, please go to dsafinancialgroup.com. All your financial planning needs can be addressed there. So give me a call. Be glad to help. Hope everyone out there has a wonderful evening, and I'll talk to everyone again next time. Adios.